7 out of 11 sectors were actually up double digits in terms of earnings per share growth, with only one actually down on a year-on-year basis, being healthcare. There is an actual rotation going on underneath the surface within the semiconductor space, right? It's no longer about GPUs. I think we're also now starting to see that shift towards inferencing chips, custom silicon, and memory. If there was ever a time to have a cushion built in where you maybe could tilt a little bit more to a hawkish tone, so to speak, this is it, right? The economy's doing well, stocks are at all-time highs. Maybe the one risk is, let's see what happens with the bond market here, because the bond market can certainly short-circuit what's going on out there.
If we get a further rise in oil, further rise in distillates, or if we're talking about 3 months from now where nothing's changed, and now we've gotten those 2 more hot CPI reports.
Yeah, that's a problem.
At that point, the Iran war is back to the forefront, and we're like less focused on the tech build-out. The bottom line is that it's pretty healthy backdrop for earnings in the U.S. across the board. So that
100%.
speaks to good economic strength, broad-based economic strength, and a couple of the tailwinds that we've been talking about.
I'm Jack Janasiewicz,
I'm Brian Hess.
and this is Tactical Take.
Hey, Jack. It's good to be sitting down for another podcast. There's been quite the market melt-up since the last time we spoke on Tactical Take. So the S&P 500 since March 30th up 16%. Through Friday. NASDAQ 100 up 26%. So it's been some pretty big moves in a short period of time. And Q1 earnings seems to have been the major catalyst for the market strength. So I thought maybe we could start by talking about what was it about tech earnings in the first quarter that propelled stocks to such a degree off those March lows?
Yeah, it all comes down to the earnings backdrop, right? If we sort of look at the summary there, earnings per share growth for the S&P 500, the broad market, up 23% on a year-on-year basis. If we take out the Mag 7, it was still up a hefty 14%. And just to put a comparison in there, Europe was up about 5% on a year-on-year basis. But I think a big chunk of the earnings are still being driven by the AI-related theme in the marketplace. So to your point, that tech backdrop is still pretty important. But I think even still, when we look at the breadth that we've seen of earnings, there are a few things worth highlighting there. 7 out of 11 sectors were actually up double digits in terms of earnings per share growth, with only one actually down on a year-on-year basis, being healthcare. But the other thing that I thought was interesting, when you look at what was going on, right, earnings are sort of going up and to the right. Estimates continue to grind higher. Same thing with margins. Estimates for margins for the end of the year continuing to push higher. Yet we're seeing a derating, or had seen a derating, with multiple contraction across the board. And so we don't really see that very often. When you get margins expanding, that tends to signify quality, right? And investors tend to like to pay up for quality, which means they're willing to assign a higher premium. We didn't get that this time around. So I thought that was one other interesting takeaway is what we're seeing with regards to multiples actually coming back down.
So I guess the derating is in part a response to concerns about the fallout from Iran, right?
100%.
There are two different market drivers, one going well, and that would be the earnings, and the other maybe less clarity. So the market's discounting the future.
And when you're rattling off those return numbers, I wonder how good those would have been had we not had such a strong earnings backdrop, because the overriding factor probably would have been the uncertainty around Iran. So.
Yeah, perhaps it would have been an even stronger, just like persistent trend, forgetting the February-March correction. Before we move on, one quick thing that came to my mind when you're talking about the year-over-year comps and the breadth of them, was there something about Q1 last year that depressed earnings to allow for so many sectors to have double-digit growth, or is it just that it's been such a good 12 months that they're...
Yeah, I think when we go back and look at the number of consecutive months of double-digit earnings growth, I think we're pushing 7 or 8 consecutive quarters. So I'm not sure it really was a base effect, so to speak. Okay. I think it was still a pretty healthy backdrop. And maybe the one caveat worth highlighting, when we look at the earnings for the tech space, you had, I think, Google and Amazon really boosted that because of their mark-to-market of their investments in the AI backdrop. Okay. So a lot of those, private investments that they've made, they've actually started to mark-to-market those, and they had a pretty significant jump up. So, if that could be worth 7 or 8 percentage points of, absolute earnings per share growth. Take those out, still a healthy number, but those are sort of one-time markups, I think, too, to keep that in the back of your head.
But the bottom line is that it's pretty healthy backdrop for earnings in the U.S. across the board. So that 100%. Speaks to good economic strength, broad-based economic strength, and a couple of the tailwinds that we've been talking about on this podcast. Okay. Well, I guess it's clear that as you mentioned, the AI build out has been a big driver of earnings growth, of economic growth. That's one of the factors I was just referring to. But I guess the question now is, as we look forward and we've got this margin expansion, we've got this persistent strong earnings growth, has the big rally in the tech space priced in too much? Or is the multiple contraction that you were talking about, like, tell us there's room to run here? How are we thinking about that? Because it does seem like some areas of the market are showing like what you would think of as classic signs of excess. I'm thinking about semiconductors, I'm thinking about memory, but maybe the Mag 7 itself isn't really too bad from a valuation standpoint.
And I think that's the question that needs to be answered, right? Because that's going to be the underarching theme that we need to figure out going forward here. But I think there's a few things that are worth pointing out here. You know, there is an actual rotation going on underneath the surface within the semiconductor space, right? It's no longer about GPUs. I think we're also now starting to see that shift towards inferencing chips, custom silicon, and memory. And I think that is partly why we're seeing such huge run-ups in names like, let's say, Micron, AMD, and Intel. And when you start to look at some of the revenue projections from, for example, the Semiconductor Industry Association calling for revenues to hit close to $1 trillion by the end of this year, I've seen a few other estimates out there, even closer to 1.3 trillion. You know, it seems like they're actually backing up some of these numbers. You know, you look at some of the things, for example, from TSMC, their first quarter revenues, almost $36 billion. It's just first quarter.
Taiwan Semiconductor.
Yeah, Lattice Semiconductor, earnings per share growth up 86%, revenues were up 42%. You know, and then you start to think about the valuations that are being placed on some of these. You know, Micron is trading at 12 times 2027 earnings estimates. So I think there's a lot of good going on here. But to your point, you know, can this earnings per share growth persist? And we tend to look at what's going on with the hyperscalers. What are they saying, right? And when you hear from the Amazons, the Googles, the Microsofts, the Metas, especially over the last couple of earnings calls that we've heard from them, they're saying basically compute demand is certainly outstripping chip supply. And so that, I think, gives the rotation underneath the surface, which is lending credence to a lot of this sort of cycling of moving from GPUs to CPUs sort of thing. And what's interesting is we sort of move from deploying AI into inference or memories. You're looking at the ratio of GPUs to CPUs shifting, right? For every 8 CPU or GPUs, you need 1 CPU. Because that's now starting to shift, I'm seeing estimates where that's now going to be more at parity going forward. And so, again, it just proves that this rotation underneath the surface is pretty healthy. And to throw a couple of data points out there, when you start thinking about high bandwidth memory, guys like SK Hynix and Samsung overseas are both basically saying they expect to see shortages through 2027. And on top of it, they're raising prices by 20%. So can it persist? It certainly seems like there's a runway out there, at least for the next year or so. But remains to be seen. You get a breakthrough on some of these language models that basically require half the compute and half the energy. Maybe that rechanges everything here. So who knows?
So it's really hard to call an end to this, given what we're seeing fundamentally. But we have to, I guess, remain somewhat skeptical that the technology is constantly innovating.
Yep.
And normally you don't see these kind of growth rates sustained perpetually.
100%.
The nature of capitalism is to come in and arbitrage that away.
And I think the two things to pay attention to, right? What are people saying on earnings calls? Are the earnings still backing it up? I guess you could say yes. And then, what are the hyperscalers showing us in terms of CapEx spend? And it just continues to go up and up, at least out to 28, 29. And so those are the data points we're paying attention to, and they're still telling us things are okay on that front.
One of the challenges for people investing in the stock market outside of just technology is that a lot of sectors have stopped participating and begun underperforming. And so the market leadership, particularly on this move from March, has been dominated by tech, with lots of industries like financials in particular struggling, and many other GIC sectors just not making new highs. So that's kind of a red flag, I think, for the broad market, that we have narrowing breadth from an individual name standpoint, but also from a sector standpoint. And then some of the parabolic price action points to the risks of, maybe a little bit of an overshoot, at least near term. But I get your point that the fundamentals are quite robust.
And I think maybe if you want to make the bull scenario to continue, all of a sudden you're going to start to see the use cases for the AI backdrop starting to manifest, which then I think helps to broaden out the backdrop here. So it's no longer just AI-related tech themes that are driving the market, then you start to see the users benefiting from that, and you see the broader market starting to
So
catch
like
up.
other sectors can become AI winners too,
Exactly.
not just technology.
Yep, remains to be seen on that one.
That's a good point.
Yep.
Before we leave Q1 earnings, any other takeaways outside of technology? Were there any other sectors, like with respect to the U.S. consumer, or anything you'd like to highlight?
Yeah, I mean, I think what we've heard from the banks, for example, and the credit card companies, were largely what we'd expected. Still a bifurcated economy, right? You still have that K-shaped economy, so to speak, where the lower incomes are getting squeezed, but the upper incomes continue to do well and continue to spend. And again, we've talked about this in prior recordings, but who does the bulk of the spending? It's still the upper incomes, so that can still be sustainable there. I thought some other things that have sort of been flashing as concerns running into first quarter earnings season. Private credit had always been sort of on the front burner. Again, comments coming out of the banks are basically saying that they're viewing this as an idiosyncratic event. Largely seems to be more retail-focused products, so BDCs. And you're hearing again from some of these managers where institutional investors are actually lining up to buy while retail is selling. So it certainly feels and seems like the indications are for that to be somewhat of an idiosyncratic
That may have been
issue.
moved from the front burner to the back burner.
Yeah,
It seems
exactly.
like, especially
Totally.
as the Iran war risk.
Yeah,
Moved to the
and
forefront.
that's a good segue to the last theme that's maybe worth highlighting is, we did hear some concerns in some of the commentary, but the concerns were more geopolitical related as opposed to demand concerns. And there's a nuanced difference there, but that geopolitical risk uncertainty backdrop is really the one risk most of the highlights that we saw from a concern perspective were pointing to.
And that's more intangible and more concern about what could happen as opposed to
Exactly.
we're concretely seeing this
Right.
deterioration.
Yep.
All right, great. Well, that's a pretty good rundown. It sounds like tech is booming and the rest of the economy is still doing fairly well also. And that's why we're getting this
Yeah.
persistent bull market.
Sure.
All right, very good. Now, when we think about, we were talking about, we have some sectors going parabolic and we have a lot priced in. When we think about potential risks or the spoiler that could be out there, the one thing that comes to mind, I think the one obvious candidate is inflation, where we've been getting increasing talk of inflation rising. And so last week we got the April CPI and PPI reports, and both were hot. Like when we look at headline CPI, that's now up to 3.8% year over year again. And when we look at even core PPI, there's a couple of different measures, but regardless of which one you're looking at, it's like 4 to 5% year over year, and that's stripping out energy prices. So these are big numbers, and I think they could start rekindling memories of 2022
Sure.
because prior to 2022, we did not see like 3.8% inflation
Right.
and
Yep.
4 to 5% PPI very often. So it looks like based on this, Fed rate cuts are off the table. And in fact, the market's now pricing a chance of a hike this year, actually. Not a full hike, but there's increasingly risk that it might happen. And at the April Fed meeting, we had an interesting lack of consensus with a variety of dissents. So I'm wondering, what did you make of the large number of dissents at that Fed meeting?
Yeah, so we had 4 dissents. Obviously, Myron a little bit of a unique
that's
dissent.
not all in the same
call that.
direction,
Correct.
but right, we did have.
So we had three members voting to, I guess, remove the easing language that was written
Yes.
into the statement. And I think the market, in our view at least, I think took that a little bit too hawkishly, only because, when we think about where we're at right now, the idea of going from easing to an easing bias to neutral to a hiking bias to hiking, so sort of along that continuum, so to speak.
There's like 5 possible stops.
Exactly.
there,
I think when you move from easing to easing bias to neutral, that's pretty linear, right? You can sort of move up and down that pretty easily. But when you start to then go to a hawkish bias and then actual hiking, I don't think it's quite linear there. I think then you start to take step ups, if you will. So, I feel like the market, in looking at those 3 dissents, assumed this linear continuity pattern going across that continuum. I'm not sure that's really the case. I think there's still a higher bar for them to move to a hawkish tilt, and even more of a higher bar to actually move to hikes. And I think that's going to be a key differentiator. So the 3 dissents to me just basically puts the market or the Fed back on. Listen, we're in neutral. We're in a holding pattern for however long it takes to see what happens with the data. And so that's how I think I would interpret the what came out of the FOMC in terms of that last meeting. It's, hey, we're going to sit on our hands for a little while and just see what happens.
I mean, given what we just talked about related to earnings and related to the stock market and related to inflation, it kind of makes sense that they should drop the easing bias.
Right.
Like, does the economy need additional
100%.
rate cuts?
Like if there was ever a time to have a cushion built in where you maybe could tilt a little bit more to a hawkish tone, so to speak, this is it, right? The economy's doing well. Stocks are at all-time highs. Maybe the one risk is let's see what happens with the bond market here, because the bond market can certainly short-circuit what's going on out there. But the backdrop, I think, is still in pretty good shape where, hey, if you just want to sit back and do nothing, that's probably not a bad thing.
You have a window of time where you can probably
100%.
safely do that.
Right.
And so with respect to rate hikes, like taking it even another step, it sounds like you're still of the view that there won't be rate hikes this year, and it's pretty unlikely.
Yeah, I mean, again, the things could change, but at least from our perch where we sit, we still put a very low probability on a hike and maybe a little bit of a door opening for potential slowing of the economy into the back half of the year. And, maybe that opens up a little bit of room for maybe an even easing, but still neutral is probably, we're in line with that.
I guess we'd have to see if we got like 3 or 4 more inflation reports like the last one. At that point, maybe a hike would become pretty tangible because there's going to be some number of like inflation reports where the Fed has to do something because they don't want to risk.
Yeah.
I mean, and look at break-evens. The 10-year break-evens are up to 2.5%, which is a pretty lofty level.
Yeah.
So I think for the Fed to kind of retain its credibility, at some point they'll have to act. But one hot report in April and sort of a medium hot one in March is probably not enough.
I think the one thing that we keep falling back on, it's the idea that in order to have a sustained inflationary impulse to go forward, it really needs to be coming from the demand side. And so when we look at things like really a no hire, no fire labor market, and then you lump on top of that real wage growth, which is actually declining, we have a hard time seeing that demand impulse pulling through. So a lot of what we're seeing today is really coming from tariffs and the energy shock. How much of Fed hikes really going to help from that? That's probably going to do more harm than good. But the risk, obviously, is if this stuff starts to bleed into the broader economy, then maybe you'll have to do something about that. But again, we still hang our hat on the idea that we're not seeing that wage impulse here. That's really, I think, the key driver where we would be concerned about inflation really coming back aggressively. Can we drift higher? Sure. But I think we're more worried about a sustained spike in inflation going forward. And we just don't see the ingredients for that right now.
And that's a big difference between the current environment and 2022. There was an element of a supply shock, a pretty big element initially in the post-COVID era, where clearly that was the initial driver of inflation. But then you had massive stimulus 100%. That was arguably overdone, which put a lot of spending power in the economy. And then you had wages growing at a very high rate relative to history.
Yep.
We're lacking the stimulus, and we're lacking the rapid wage growth this time around. We mostly have the supply shock. So maybe that'll limit the pass-through from headline to core or the durability of the high inflation.
Yeah. And that's why I think you have time to wait this one out from the
Fed standpoint. It's easier for them to look through it.
Right.
All right. That makes sense. Now, one thing we spent a lot of time talking about the prior 2 episodes is the situation in Iran. I feel like we should check in probably briefly because not much has changed since the last time we talked. Oil prices are still high. I think WTI is 105 this morning as we're recording, and refined products are still elevated. And really, there doesn't seem to have been a tremendous amount of progress on the discussions, the negotiations between the U.S. and Iran. So I guess what are you focused on with respect to that war right now? Like, what are you looking for to tell you one thing or another?
Yeah, it's really sort of the market's impressions looking out. So the 1 year forward inflation numbers, they're still remaining decently contained, drifting up a little bit, but not taking off. Looking at those FAR contracts for delivery on WTI or Brent, those are moving back up to the upper end of the range. So certainly seeing plenty of ideas that, maybe oil prices will end up being higher for longer. Inflation doesn't seem to be really moving quite as much, but that's sort of the things that we're paying attention to in here. And then the other one, too, is the distillates market, right? Because they're going to be a little bit more twitchy, if you will, in terms of reacting to shortages out there. And so things like jet fuel prices, heating oil prices, those sort of things, that are well off the highs, but still elevated. So until those start to kind of come down again, there is still the outside risk that, the higher for longer in terms of this uncertainty starts to bleed back through and things start to drift back up again. So are we out of the woods yet? Not by far, but the market seems to still be looking past this.
So the war still has the potential to be market moving. It seems like it's lost some of that impact recently, but I guess your point is, like, if things just remain status quo for the time being, it's probably not a big market moving event. Things will be we'll be more focused on what's going on with memory
Yeah.
and the tech investment. But if we get a further rise in oil, further rise in distillates, or if we're talking about 3 months from now where nothing's changed,
Same, yeah.
and now we've gotten those 2 more hot CPI reports,
Yeah, that's a problem.
at that point the Iran war is back to the
Yeah.
forefront, and we're like less focused on the
Yep.
tech build out.
100% agree with that.
All right, well, we'll check in then next time
Spot
again
on.
and see how that goes. All right, now we made a model trade since the last time we chatted and added a couple of new positions. So I figured it makes some sense to talk through the theses behind these 2 new ETFs that we purchased. So the first one, ticker AIRR, that's the First Trust RBA American Industrial Renaissance ETF.
Yep.
And this is built around the idea of reshoring, building out manufacturing, making America great again. But can you get into it a little bit more for the audience? What was the thinking behind AIRR?
Yeah, and we're going to go into both trades here. So I think the thesis really applies to what we're going to talk about for both of these
All right,
positions.
so let me just bring in the other one while we're at it. So
Sure.
the second ETF, ticker PIC, PICK, that's the iShares MSCI Global Select Metals and Mining Producers ETF. So that's more of a global, not more of a, it is a global ETF, whereas AIRR is a domestic one. But they are related in a way, so
Yeah.
there you go.
So I think when you look at what we've gone through, right, we've seen a bunch of supply shocks hit the economy, going all the way back to COVID, to Ukraine and Russia, to what we're seeing today in Iran. And, I think that's put a lot of pressure on the ability to sort of navigate these concerns going forward there. Later on top of the idea that we're seeing, I think, with some of the Trump policies going forward, we've become a little bit more isolationist, if you will, sort of pulling back from the global stage and really focusing more on the United States itself. And I think we've traditionally seen a bipolar world where it's really been China, U.S., and everybody else, moving more to, I think, a multipolar world. And you can sort of draw those parallels sort of up and down the globe. So you've got the U.S., Latin America sphere, maybe the Europe sphere, the Asia sphere, Japan itself, and then China and Russia. But you can all suddenly now say maybe there's 5 or 6 different spheres, if you will. But with each one of those, you want to become more and more independent, right? You don't want to be reliant on others around these spheres to sort of help continue to build you out, so to speak. And so I think that puts a precedent or a greater importance on national security issues. And that, again, goes back to what we saw during COVID and the supply chain problems that we ran into. So when you're starting to talk about potential concerns, national security interests take the forefront. What's the next thing to think about? Well, you got to go through what's key there. Well, semiconductors, the chips are going to be important. Raw materials, critical minerals, those sort of things. That's part of the national security story. And that means we need to do a lot of that, at least at home or maybe within our sphere of influence. And I think both of those sort of tickers that we just talked about sort of play into that theme. AIRR plays into sort of the global reshoring, onshoring, or the U.S. reshoring, onshoring theme. Less reliant on our partners overseas. PIC is really a play towards those raw materials, those critical minerals. And that's really, I think, the underarching theme that we're trying to get to. And maybe add one other thing in there. We start to think about, for those who follow our some of our consultants here that use the cyclicality versus inflation theme work. We're sort of trying to move a little bit up and to the left, so to speak. A little bit of cyclicality as well as a little bit of inflation backdrop.
So more cyclical sensitivity or growth sensitivity and more positive inflation sensitivity. Stocks that do well in a rising or high inflation environment.
Exactly. So that sort of reflationary environment, and these two basically put us up into that quadrant. So trying to get exposure to those themes as well.
So this is regionalism over globalism.
Yep.
This is about countries building up national champions and securing access to raw materials for those national champions.
100%.
And that's our medium-term theme across the board. Okay. Now, we did have to cut one position in order to make room. Well, not even to make room for it. We had to cut a position for risk management purposes, but we also used it as a funding source for the new ideas. And that's ILF, the iShares Latin America 40 ETF. We still like Latin America on a secular basis, but it does seem like near term, some of the inflation concerns we were highlighting earlier may have hit with a bit more impact in Latin America. So we know Brazil is one country where the central bank is now probably going to be hiking rates.
Yep.
Is that the basic reason here for ILF? It got off to a great start for us. One of those trades where you're like, wow, we put this on at the perfect time, but it rolled over hard in relative terms. And
Yeah, I think the Bovespa does tend to trade very well
That's the Brazilian
with
equity index.
Yeah, trades very well with the idea that the Copom, the central bank there, will be cutting rates. There's a high correlation, high beta to that. So when we first put that trade on, the market was still anticipating several more rate cuts coming from Copom. That has since changed. So I think that's really the underarching theme with regard to the Brazilian equity market. In our view, is highly levered to the rate cut backdrop, and those rate cuts have evaporated. So let's take a little bit of that off and go elsewhere.
And even though it's called the Latin America 40 ETF, Brazil, I believe, makes up a majority of the actual ETF, so it's very sensitive to what's going on in Brazil.
Right.
Okay, thank you. Now, with this trade, we remained 1% overweight stocks, and that does seem to follow logically from everything we've talked about over the course of this episode. But last question, can you just explain why we're so comfortable being overweight stocks despite the massive rally in the S&P 500 since late March?
Yeah, listen, are we subject to a potential correction in here given the run-up that we've seen? I mean, we look at a lot of the position indicators. Certainly they look a little bit stretched in here. So would it be shocking if we get a 5 or 10% correction? No. But I think, and again, those are normal in market cycles. In bull markets, we do get these sort of profit-taking sections. But the
and we're not trying to trade around every zigzag 100%. In the market.
That's what we're trying to get to here. We're not going to sit there and try to call 5 and 10% corrections. Right. The bigger theme for us is still really what we opened up with in here. It's that the earnings backdrop. When you're talking about earnings that are coming in at 15, 16% and expected to continue to grow, you're seeing margins continuing to grow. That backdrop's pretty conducive to stock prices continuing to push higher here. And, what tends to short circuit this backdrop, it's usually when the Fed starts to hike. And as we sort of just talked about, at least between now and the end of the year, we're not seeing a Fed hike potential coming in yet. So I think the backdrop is still supportive. Is it great? I would say it's great, but it's also not bad, and that's probably the sweet spot for the market. And corporates are going to do what they do, and that's post earnings.
I think what's happened probably is that the rate hike fears have crept up a little bit, and so certain parts of the market that are more sensitive have begun underperforming. Like I mentioned, financials, but also small caps have started rolling over in relative terms. So if we're focused on U.S. large caps, which is where our overweight exists, then for now we should be insulated for the reasons you just highlighted.
100%.
But we have to keep an eye on that Fed story.
Yep.
All right. Well, thank you, Jack. It was a good discussion today. It's been an interesting year, and I think it'll probably continue in that direction. So I look forward to next episode and sitting down again. Thanks a lot.
Excellent. It was fun.